Hi everyone! Recently, the price war between JD.com, Alibaba and Meituan has started to cool down, leading to a reduction in subsidies for tea drinks. So today we are going to analyze the market leader, Mixue, and see how the company is doing right now. Mixue was founded in 1997 when Zhang Hongchao opened a small shaved ice store in Zhengzhou. 2 years later, he adopted the name Xue Bing Cheng. The company's first major breakthrough came in 2005 with the launch of an ice cream cone priced at only RMB 1, establishing the positioning that Mixue has maintained ever since, selling simple drinks and desserts at extremely low prices. In 2007, Zhang Hongchao's younger brother joined the company and helped accelerate the development of a franchise network. Mixue then launched another flagship product in 2013, its freshly squeezed lemonade. Together with fresh ice cream, it was still among the company's 5 best-selling products in 2025. At the same time, Mixue was building the infrastructure required to support a much larger network. The group established its first centralized factory in 2012 and began developing its own logistics system in 2014. It then opened its first overseas store in Vietnam in 2018 and introduced Snow King, which later became one of the most recognizable brand mascots in China. Over the following years, Mixue continued to expand rapidly before listing in Hong Kong in March 2025. The group has also developed the low-cost coffee brand Lucky Cup and acquired the fresh beer chain Fulu. Although these activities remain relatively marginal, and the business still depends overwhelmingly on the original Mixue brand. In terms of business model, Mixue is quite similar to Chaji, another company that we have already analyzed on this channel. The group mainly relies on franchising. Franchises finance and operate almost all the stores, while Mixue provides them with the ingredients, packaging materials, equipment, and services they need. This model has allowed the group to expand extremely rapidly. We can clearly see the results on this chart. The expansion of a store network has been quite staggering, with a number of stores almost tripling between 2021 and 2025. Where Mixue is a little different from Chaji is that the group owns several factories where it produces its core ingredients before selling them to franchises. It currently has 5 production bases in China, as well as 28 warehouses and its own logistics network. Even though franchises finance almost all the stores, Mixue is therefore not a purely asset-light company. There is a real industrial and logistic infrastructure behind the business. Total system GMV increased significantly between 2021 and 2024, while average GMV per store remained relatively stable despite the very strong expansion of the network. When the number of stores almost triples, there is always a risk that new locations will cannibalize existing ones and reduce average store productivity. But we don't see a clear sign of that here. There is, however, a transparency issue with the 2025 figures. For some reason, Mixue stopped disclosing system GMV and average GMV per store in its 2025 annual report. I really don't understand this decision, because these are major indicators for a franchise business, and the company had previously provided them. Their disappearance from the annual report is therefore not a positive sign in terms of transparency. I tried to estimate the 2025 figures using the information that remained available. Based on my calculations, total system GMV may have reached approximately RMB 78.2 billion, while average GMV per store may have increased to around RMB 1.48 million. These estimates need to be treated with caution, because I don't have all the information required to calculate them precisely. Based on what I was able to calculate, average GMV per store didn't appear to decline significantly in 2025, while total GMV seems to have continued growing strongly. So there doesn't appear to be a major problem on this side, although 2025 was a very unusual year for the Chinese food delivery market. The price war between JD.com, Alibaba and Meituan resulted in extremely aggressive subsidies, particularly for tea drinks and other low-priced products. Mixue clearly benefited from these promotions, which increased order volumes and probably contributed to the strong growth in sales and system GMV. Now that the price war is losing intensity and subsidies are being reduced, the 2026 figures will be particularly interesting. They should give us a better idea of whether Mixue can maintain its store productivity when customers are once again paying prices closer to normal levels. When we look at gross margin, I think the management handled the situation quite well. Mixue's overall gross margin remained relatively stable over the last 5 years, fluctuating between approximately 28% and 32%, although it declined from 32.5% in 2024 to 31.1% in 2025. The margin generated from goods and equipment was more volatile because it mainly depended on changes in raw material costs and the company's ability to pass those additional costs onto franchisees. This margin fell from approximately 31.2% in 2024 to 29.9% in 2025. At the same time, the margin generated from franchise services improved quite clearly, reaching 82.6% in 2025. Franchise services, however, represented only 2.4% of group revenue. Despite its very high margin, this activity remains too small to have a major impact on the group's overall profitability, which is still mainly determined by the ingredients, packaging materials, and equipment sold to franchisees. Overall, maintaining a relatively stable gross margin despite raw material inflation and the very rapid expansion of the network is clearly a positive point. The combination of strong revenue growth, rapid store extension, and relatively stable gross margin translated directly into earnings. Earnings per share increased from RMB 5.32 in 2021 to RMB 15.65 in 2025, meaning that EPS almost tripled over the period, broadly following the expansion of a store network. In 2025 alone, EPS increased by approximately 27%, slightly less than attributable net profit, because the IPO increased the weighted average number of shares during the year. On the financial structure, I don't have many negative comments to make. At the end of 2025, Mixue had approximately RMB 7.43 billion in cash and cash equivalents, against only around RMB 190 million in financial debt, giving the company a net cash position of approximately RMB 7.24 billion. The balance sheet is therefore extremely strong, and Mixue has more than enough liquidity to finance its current investments. The industrial side of the business becomes more visible when we look at capital expenditure. During the previous years, Mixue invested heavily in factories, production equipment, warehouses, and logistics infrastructure to support the rapid expansion of its store network, with capex reaching a peak of approximately RMB 1.69 billion in 2023. By 2025, capex had declined to around RMB 692 million and represented only 2.1% of revenue. This suggests that much of the infrastructure required to support the current network had already been built, allowing Mixue to generate much more revenue without increasing investment at the same pace. I wouldn't automatically assume that the 2025 level represents the new normal. The annual report says that Mixue intends to continue investing in production capacity and cold chain logistics, while the group also plans to develop full in-house production capabilities following the acquisition. Capex could therefore increase again, even if the most capital-intensive phase of Mixue's original supply chain development may now be behind it. Cash generation also benefits from the way Mixue manages its working capital. Operating working capital declined from approximately 11 days of revenue in 2021 to around 6 days in 2025. Franchisees generally pay Mixue before receiving products, while the company benefits from rapid inventory circulation across its enormous network. So very little additional working capital is required to support revenue growth. The combination of strong earnings, lower capex intensity, and efficient working capital management had a direct impact on free cash flow. Free cash flow per share increased from approximately RMB 2.06 in 2021 to RMB 14.09 in 2025, and represented around 90% of earnings per share that year. The company was basically printing cash in 2025, generating much more profit while investing considerably less than during the previous phase of its development. This is a very positive situation, although we need to remember that investment in production capacity, cold chain logistics, and the full business could increase again in the coming years. In terms of future growth, I think we need to distinguish between China and overseas markets. Mixue currently has more than 55,000 stores in mainland China. This figure is so large that it can be difficult to fully appreciate on its own, but the comparison on this chart makes the scale much clearer. Mixue is far ahead of the other major tea, coffee, and even fast food chains in China, which is quite spectacular. Despite this enormous network, I don't think the company has completely reached its limit in China. There is probably still some room to open additional stores in lower tier cities and townships. Over the very long term, however, I have difficulty imagining the domestic network exceeding around 80,000 stores, which would already represent a very high ceiling. Compared with the current network, this will still leave potential growth of around 40 to 45% in the number of stores in China. The Chinese tea drink market could also benefit from a favorable demographic effect. Older Chinese consumers still tend to drink tea in a much more traditional way and generally consume fewer freshly made tea drinks. As this generation is gradually replaced by younger consumers, the potential customer base for these products should continue to increase. Today's younger consumers will also probably retain at least part of these habits as they grow older, supporting long-term growth across a wider tea drink market. I nevertheless see a more specific long-term risk for Mixue. In the current economic environment, its extremely low prices are a major advantage because Chinese consumption remains relatively weak and consumers are paying much more attention to how much they spend. But as the Chinese middle class continues to develop, particularly in Tier 1 and Tier 2 cities, consumers may gradually favor more premium products that are perceived as higher quality and healthier. Mixue's products are generally not perceived as particularly premium or healthy, even by Chinese consumers. The company could obviously adapt and introduce higher quality products, but moving too far upmarket could conflict with the low-cost image that has made the brand successful. This could therefore become a long-term headwind. Overseas, Mixue expanded extremely rapidly, going from only 270 stores in 2021 to more than 4,000 today. The trend weakened quite clearly in 2025. However, as the number of overseas stores declined from 4,895 to 4,467, showing that the expansion has started to encounter some difficulties. The company initially developed mainly in emerging countries with relatively low purchasing power, where its low prices were particularly attractive. But this very rapid expansion also created problems with store operations, hygiene, and food safety controls at some franchised locations. Management will probably need to strengthen its oversight of franchisees and ensure that operating processes are properly respected, which is naturally more difficult to manage overseas than in China. Despite these problems, there is still meaningful potential in emerging markets. Southeast Asia remains the most obvious region because of its proximity to China and the popularity of tea-based drinks. But the opportunity could also extend beyond Asia. The group's planned investment in Brazil is particularly interesting and could become an important test of whether the Mixue model can work on a much larger international scale. At the current share price, Mixue is trading at around 12.4 times its 2025 earnings. Honestly, this doesn't seem particularly expensive for a company that is still growing and is by far the market leader. If I wanted to invest in Mixue, the maximum valuation I would be willing to pay would be around 13 times earnings, so the current price is relatively reasonable. There are, however, 2 points that prevent me from buying the shares. The first concerns short-term growth. As the price war between JD.com, Alibaba and Meituan gradually comes to an end, subsidies on tea drinks will probably decline, which could have a negative impact on Mixue's sales in the short term. Of course, the company was already able to increase both its number of stores and its total sales before the subsidies, so I don't see this as a major long-term problem. Management also appears to be becoming more cautious. Store openings will probably slow considerably in 2026 as the company focuses more on improving the quality and performance of existing locations. Mixue still has long-term growth potential, but the expansion of the network clearly seems to be becoming more difficult in the short term. The second point, and the one that concerns me the most, is capital allocation. Mixue has a very large amount of cash and is generating strong free cash flow. But for the moment, there is no direct return of capital to shareholders, no dividend and no share buybacks. Management may be retaining this cash to finance international expansion, new production capacity, or projects such as Brazil, but Mixue remains mainly a franchise business, with franchisees financing almost all the stores, so it's difficult for me to understand why the company needs to retain so much cash. If it simply remains on the balance sheet and is invested in low-return short-term products, it doesn't create much value for shareholders. Personally, I don't like investing in a company that generates a lot of cash but has no visible policy for returning part of it to shareholders. This could obviously change in the future if Mixue eventually introduces a dividend or starts repurchasing shares. But for the moment, it remains a major negative point for me. Overall, I don't think Mixue is expensive at the current price, and the valuation is already close to a level I would consider acceptable. However, because of a weaker short-term growth outlook and above all the absence of any visible return of capital to shareholders, I wouldn't invest in the company for the moment. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe and share.